Yeah. All right. Well, the stock market rally may be on borrowed time. Our next guest sees a significant rebound ahead in the benchmark 10-year yield. Market forecaster Jim Bianco runs Bianco Research. Jim, great to have you with us. We were just saying how maybe it's all about rates. And if that's the case, then this is bad news for investors who are bullish, who are long. You're saying 5.5% is where we're headed on the 10-year.
Yeah, I was on with you a month ago, and I said, the 10-year's going to 5.5%, and it's been a terrible month for that call, but I'm still there at 5.5%, say, in the first half of 24. And the reason is I don't think we're going to have a recession. And I think that the inflation rate is bottoming somewhere around 3%. So if you've got 2-ish to 3-ish growth in the economy, which is what it's been for the last 5 quarters and projected to be in the current quarter, and say 3 on inflation, that's 6% nominal growth. I put a little fudge factor in there, and I got 5.5% on the 10-year note because the 10-year yield should somewhat approximate where nominal growth is. So that means that the economy, interest rates should probably bottom out here in the next month or so and continue to move higher. What does it mean for stocks? I heard you guys talking about this earlier. I think the biggest problem stocks have now is there is an alternative. There is an alternative in 5.5 to 5.25 money market funds. Dr. Jeremy Siegel just finished a new edition of his book, Stocks for the Long Run. And he says over the long run, the stock market should, over many, many years, give you an 8% return. Well, if I could get 5.5 or so in a money market fund, I'm getting 2/3 of that with no risk. So the stock market's really got to do something better than average to get people interested. And all we've seen it do so far this year is get people interested in AI. Because if you take the AI stocks out of the S&P or the S&P 493, they're collectively up 3.5% this year or less than cash. And I think it's not because the economy's bad. I think it's because the competition of higher rates is a problem. So if rates move up in the first half of 24, that hurdle is going to be bigger for the stock market.
Is a backdrop to your call for rates to go to 5.5% that the Fed is done, Jim, and rates go higher anyway?
Yeah, I think the Fed is at least done. I don't think that they're going to be cutting rates. I'll point out that it's been almost 35 years since the Fed has cut rates with core inflation above 3.5%, and we're at 4% right now. So unless there's a serious deceleration in core, I don't think they're going to cut rates at these levels. And I wouldn't be surprised if there's talk in the first half of 24 of one more rate hike, just one more. But that's just one more. But I'm really more emphatic about the idea that I think that all the rate cut talk is a little bit premature. The idea behind that is interest rates, the Bill Ackman real rates at 2 or 2.5% is going to be punishing for the economy. I don't see that. I think the economy can handle 2.5% real rates. It did before QE. And it will now, and that's why I don't think the Fed will see any urgency in having to cut rates, despite those seemingly high real rates.
Jim, you talk about this. It sounds like this is rates going higher is a good situation for the economy for all the reasons you just stated, the move to 5.5%. But does something break on the move to 5.5%? I mean, servicing the U.S. debt at 5.5%, it's a much different environment than where we are now. A lot of things can happen that are bad on that train the train north of 5% on its way to 5.5%.
100% agree. Ben Bernanke in 2019 said economy expansions, which we're in now, or no landing as we like to call it, don't die of old age, they're murdered. And some murder weapon has to show up, whether it's COVID, a spike in gasoline prices or crude oil, or a financial crisis, or some unknown event comes through and murders it. So yes, there are potential murder weapons out there, and we can't predict those. But short of a murder weapon, I don't think you're going to see that type of breakage of the economy, at least at this level. You point out about higher interest costs for the U.S. government, and that's true, and that is an issue. That as interest rates go up, the U.S. government has to pay higher interest costs. But on the other side of the equation, businesses are improving their financial position because of this, because more businesses are seeing an increase of interest income over interest expense. Their cash that was earning them 0 is earning them 5. And as a group, businesses are better off because of higher rates, because of those cash flows from income, than they are being burdened by those expenses. Now, it differs from company to company, but they're a big offset to the government right now in terms of they're benefiting from higher rates where the government isn't.
Jim, always great to get your thoughts. Thank you.
Thank you.
Jim Bianco.